It wasn't optimism. It wasn't a sudden burst of economic productivity. It wasn't even the brilliance of central bank policy. It was a mechanical compulsion, a blind, algorithmic force. Billions of dollars moving not because they wanted to, but because they had to. We are watching a massive liquidity event, a tidal wave. Estimates suggest $50 billion hitting the market, all in the month of January. Pension funds are panic buying, but they aren't buying value. They are buying compliance. They are deploying capital into a market that is historically stretched. And history suggests this is not a beginning. It is a trap. This isn't prophecy. It's positioning under constraints. To understand why this wave is dangerous, you must ignore the headlines. Ignore the political noise. Look only at the plumbing. The incentives of the largest capital pools on Earth. When you strip away the narrative, you find a machine that cannot stop, even when the cliff is visible. Let's open the first case file. The United States. The early 1970s. The era of the Nifty 50. Institutional managers faced a dilemma. Inflation was stirring. Bonds were becoming dangerous. So, the herd moved. They piled into 50 specific stocks: Xerox, Polaroid, Eastman Kodak. They bought at any price. Valuations hit 50, 60, 80 times earnings. The constraint was the need for perceived safety. The incentive was career risk. If you bought Kodak and it fell, you were unlucky. If you bought a small cap and it fell, you were fired. So they bought the peak. January 1973 marked the high water mark. Then the liquidity tide went out. The bear market of 1973 to 1974 destroyed them. Assets fell 50%. The forced buyers became forced sellers. Case file number 2. The turn of the millennium. 1999 pension funds were underfunded. They needed 7-8% returns. Bonds couldn't provide it. The constraint was actuarial math. The incentive was to chase growth. They poured billions into the technology sector, not because the balance sheets made sense, but because the mandate demanded exposure. In January 2000, inflows surged. The market melted up. It looked like a new golden age. It was actually the final distribution phase. Smart money was handing the bag to the pension funds. By March 2000, the trap snapped shut. The Nasdaq lost nearly 80% of its value. The pension funds that panic bought the top spent a decade recovering. Case file number 3. October 2007. The peak before the great financial crisis. Institutions were fully allocated. Risk models showed low volatility. The constraint here was liquidity. When the subprime cracks appeared, the big players tried to move. But you cannot move an elephant through a keyhole. As 2008 began, they tried to rebalance. But the market depth wasn't there. The constraint of size turned into a death spiral. They sold what they could, not what they wanted to. Good assets were liquidated to cover bad debts. The entire system froze. Now, look at the mechanics driving this January. The engine of this volatility is not sentiment. It is structure. Pension funds operate under rigid mandates. They collect contributions from workers. They have target allocations set by committees months or years in advance. When a new calendar year begins, vast sums of cash current estimates range between $40 and $50 billion must be deployed. This is not a choice. It is a contractual obligation. The fund manager at a state pension system does not care. If the price-to-earnings ratio is 30 or 15, they care about their tracking error. If the S&P 500 is the benchmark, they must own the S&P 500. This creates a phenomenon known as price-insensitive buying. For the first few weeks of the year, this wall of money hits the market, overwhelming sellers and driving prices up regardless of fundamentals. It creates the illusion of health. It paints the charts green, but it is artificial demand, driven by a calendar date, not by economic reality. Current data suggest we are walking directly into this trap again. The indices are trading at historic premiums, yet the January inflows are arriving on schedule. The risk is not the buying itself. The risk is what happens when the buying stops. Once that $50 billion is deployed, the bid disappears. The artificial support vanishes. The market is left unsupported at a dizzying altitude. History shows that these mechanical rallies are often the final act before a correction. The smart money knows the schedule. They know the pension funds must buy in January. The incentive for the sophisticated player is to sell into this strength. They use the liquidity provided by the pension funds to exit their positions. The pension fund becomes the bag holder, buying the top because their rulebook says they must. Under these constraints, the rational move for the insider is to feed the ducks while they are quacking. Some analysts argue that this liquidity is purely bullish. They claim that $50 billion of fresh equity demand creates a permanent floor under the market, and that demographic trends ensure these inflows will continue indefinitely. They view this as a perpetual motion machine of asset appreciation where passive flows absorb all volatility. But this view ignores the other side of the ledger. The incentive structure has changed. As baby boomers retire, pension funds switch from being net buyers to net sellers. They need liquidity to pay out benefits. The arithmetic is merciless. The inflows we see in January are becoming smaller relative to the outflows required for distributions. We are approaching a tipping point where the selling pressure from retirees outweighs the buying pressure from workers. When that scale tips, the mechanical buyer becomes the mechanical seller, forcing liquidations regardless of price. We are left with three potential endgames. The first is controlled decline. This is the scenario of financial repression. The value of the currency is slowly eroded to keep nominal asset prices high, while real returns turn negative. We saw this in the post-war period of the late 1940s, where bondholders were slowly liquidated by inflation while nominal GDP grew. The pension funds remain solvent on paper, but the purchasing power of their payouts collapses. The system survives, but the promise is broken in real terms. The second endgame is chaotic collapse. This occurs when the liquidity mismatch becomes acute. The keyhole problem of 2008 returns. If a geopolitical shock or credit event hits while pension funds are fully allocated at the top, they rush to the exit simultaneously. But in a market dominated by passive flows, there are no active buyers to catch the falling knife. Prices gap down, and the solvency of the system is questioned overnight. The third endgame is reset and restructure. This is the historical norm when obligations exceed resources. It involves a fundamental change in the promises made. We saw this in the restructuring of the Soviet bloc economies in the 1990s, where state guarantees were dissolved and assets were repriced in a new reality. In the West, this might look like means testing benefits, raising retirement ages, or a direct monetization of pension deficits by central banks, a bailout that effectively resets the currency. The only variable is timing and pain. Subscribe to the channel. Do not rely on the mechanical flows of others to protect your future. Study the constraints, watch the liquidity, and prepare accordingly.